John, good morning to you. When you look at some of the things that the market has been focusing on, it's definitely monetary and fiscal stimulus. How do you view the complex situation with, cases surging with COVID-19?
So look at most of the forces as being quite positive because obviously you have monetary stimulus in play. There are always suggestions that fiscal policy could be upsized as well. The data are moving up. The data, as they move up, are beating expectations. And so that just leaves the coronavirus issue, to me, as a little more of a wild card than anything else. Obviously, these infection rates are moving up in a lot of U.S. states and, importantly, some large U.S. states. But the rate of infection, the rate of growth of the infection is still pretty modest. It's not really presenting a challenge to hospital capacity. And that's why it doesn't raise this immediate threat of lockdown. So it's right to view this as a risk factor. I just don't think it's such a dominant factor at this stage that it justifies turning defensive or negative on markets.
So, John, where do you see the most value amongst asset classes right now?
So I don't think there's a huge amount of value simply because the size of the retracements that's occurred since March has been very large. But if I think about where there's modest value, I think there is modest value in credit because spreads are still slightly wide to their long-term average. And obviously central banks are buyers of credit. I think there's modest value in equities, even though PEs are fairly elevated. That's basically because I think the business cycle is just going to continue normalizing over the next few quarters. And I think there's actually decent value in big short dollars because that's the catch-up trade. The dollar is the defensive asset that's still fairly expensive. The flip side of that is that a number of EM assets, EM currencies, are fairly cheap. So that's probably the bigger rotation just over the next month is focusing a little more on the EM complex and some of the cheaper currencies.
John, translate for us your very, very complex notes written at JPMorgan about what the asset classes, and particularly fixed income and foreign exchange, signal for the equity market. You just said equities are constructive here. How do you take those signals to get to a constructive view on equities?
For me, the big signal out of fixed income markets is there's going to be financial repression for the next few years, meaning massive central bank asset purchases that offset these exploding deficit figures and issuance. So low rates is going to be the norm for a very long time. That's one less thing for equities and credit and EM to worry about as a potential disruptive force. The signal I'm not taking from fixed income is that growth is going to be underwhelming over the next couple of quarters, and that's why rates are low. Remember that the rates markets are managed markets, and they're managed through QE programs. So there's not a whole lot of signal in terms of the strength of the economy that's coming out of the bond market. Where you are getting more signal is about the policy commitment to keeping rates extremely low for a very long time. And I think of that as fundamentally supportive for the risk complex.